I think we'll get started now. Good morning, and thank you for joining us for today's webinar, Hedging Choices in a Volatile Market. What can I do today? My name is Tom Thompson. I'm a first vice president and commercial banker in Illinois at Bankers Bank, and I'm excited to be your host for today's session. I have with me from Bankers Bank, Tammy Haas, our Director of Marketing, who will be assisting with our presentation today. I'd also like to welcome and introduce David Sweeney, a Managing Director and our representative from Chatham Financial. David will be taking you through the presentation today, but before I turn it over to him, I have a short message and a commercial about our sponsor, Bankers Bank. And due to the number of attendees, your phone lines and computers have been muted. Please submit any questions via the chat box, and we will get to as many as we can at the conclusion of the presentation. We are recording this webinar, and we will share a copy of it along with the slides to all attendees. Please complete it and share any ideas you have for future webinar topics. Bankers Bank is a Midwest's leading provider of correspondent banking services to community banks. As an independent source of non-competing financial services, we service a market of over 1,200 financial institutions in the 6-state footprint of Wisconsin, Iowa, Indiana, Illinois, and we've just recently expanded to Michigan and Ohio. We know community banking because your business is our sole focus. Our leading technology platforms are designed to make you, our community bank customers, more efficient and competitive. With over 70 products and services, we provide a strong portfolio of innovative solutions to help community banks thrive so they can focus on the needs of their customers and community. As a commercial banker, I would be remiss in not mentioning that we offer senior debt term loans and lines of credit, and Bankers Bank last year started placement of subordinated debt for bank holding companies. We provide director and officer loans. We can help banks with commercial loan participation sales and purchases. Our expertise in leasing products and SBA 7(a) services offer you and your customers greater options. Our commercial bankers are experienced and can provide insight on various industries and the markets we serve. We welcome opportunities to work with you and your commercial lenders, so please don't hesitate to call us. Now, back to our topic of the day, hedging choices. Our partnership with Chatham Financial came about because we listened and heard that community banks wanted swaps or the ability to hedge particular loans or portfolios. And with that, I'd like to ask David to share his insight on just how banks can use hedging to reduce their uncertainty. David?
Thank you, Tom. Much appreciated. Again, my name is Dave Sweeney. I will be taking you through this journey today of different hedge strategies that you may be able to use at your bank to help you through the current interest rate environment. Taking you through the agenda today, I'll start off with a brief introduction to Chatham Financial. For those of you who don't know us, I'll give you an idea of how we're working with financial institutions like you and using derivative products. I'll then go through 3 hedge strategies that are very common today and just a bit different, each one of them. The first one is for financial institutions that are looking to hedge to protect against rising interest rates. So if you have the view that short-term rates are rising sometime soon, you may want to put on this hedge strategy. With this example, I'm also going to show for those banks that use FHLB advances, term FHLB advances, to perhaps match fund long-term commercial real estate deals. I know some banks, if they're doing a 7, 8, 9, 10-year commercial real estate deal, they'll use FHLB match funding for that same term. I'll show you a way that you can do it using short-term funding with an interest rate swap to reduce your cost of funding. So that's a good strategy and it's been used for years. The second one, I think, is one of the more interesting ones today. This is really for banks that are sitting on a lot of cash and are looking for ways to deploy the cash in the low interest rate environment. We call this strategy own the front end, hedge the back end. And with that, the trade is to buy a long-term bond and hedge it with a swap. What it allows you to do is increase current asset yields while still protecting market value changes. So it gives you the current net interest income, but also protects you from EVE risk or market value risk or price sensitivity risk, whatever you want to call it. The third strategy I'll go through is just the opposite of the first strategy. This is for folks who think interest rates are going to stay low and stay persistently low for an extended period of time, and they're just looking to pick up current income. They need more net interest income. So we're going to use receive fixed interest rate swaps, just the opposite of the first example, to do what that institution needs to do. So that's the three strategies: hedging FHLB advances with pay fixed swaps, and all the way down to receiving fixed swaps. So we got a lot of things covered here today. As I mentioned a little bit about Chatham, we're an independent derivatives advisor. What does that mean? It just means we're not a broker dealer. We work for you. We sit on your side of the table in executing derivative trades efficiently and effectively. We're going to take care of everything that needs to be taken care of related to the derivative service. So from trade execution all the way to accounting entries and financial reporting and everything in between. We are 600 plus employees, and we're an employee-owned institution. We are headquartered in Kennett Square, Pennsylvania, just right outside of Philly. We're fortunate to serve over 3,000 clients worldwide, but here in the United States in the financial institution space, we're fortunate to have over 200 banks that we work with, ranging in asset size from about 200 million to over 100 billion. So just everything in between that. Lastly, we're in the market every day. We trade on average about 2 billion in notional and swaps a day. So you're going to get the benefit when you're working with us in getting efficient and effective execution. Here on the right-hand side, you can see the services that we provide. Balance sheet hedging and loan level hedging are the primary services that we're offering financial institutions, and they're using us for. And when we look at today, or let's look at the reason that banks are using derivatives. They're using for balance sheet hedging. So they're looking to reduce or lock in funding costs. They're looking to improve asset yields, and really just overall managing their interest rate risk position or asset and liability sensitivity, whatever you prefer to call it. Now, loan level hedging, which we're not going to talk about today, that's a way to offer fixed rate loans to customers and keep floating rate loans in your books. And at the same time, you're going to book fee income. But as I mentioned, today is the balance sheet hedging side of the equation. And when we look at balance sheet hedging, we look at the hedged item. The first trade example I'm going to give you, the strategy I'm going to give you, is hedging FHLB advances. The second strategy will be focused on the securities portfolio. And the last hedge strategy will be on loan pools, so pools of floating rate loans. So with that, let's get started with the strategies and how we get there. Really, the two critical questions we're going to ask our clients whenever we're looking at strategies. First is, what's your interest rate view? What do you think short-term interest rates are going to do? What do you think long-term interest rates are going to do? How long is it going to take for that move to take place? And we're going to talk about that to make sure we understand what your views are and ensure that your views are reflected in the strategy that we provide and suggest to you. The second most important thing is, what's your current interest rate risk position, or your NII sensitivity or EVE sensitivity? So putting those two together will help inform us on what type of strategy that we think makes sense for the situation that you're in. So let's take a look. As I said at the outset, if your goal is to protect from short-term interest rates going up, so if that's your view, we're going to suggest a pay fixed interest rate swap. Now, the hedged item in that, and I'm going to show you an example, is going to be, as I mentioned, the rolling FHLB advances. Now, we can use brokered CDs as well. That's okay. But the example I'm going to give to you today is rolling FHLB advances. Another goal could be, again, I'm sitting on a lot of cash. I'm looking for ways to deploy that cash. I could buy securities, but the only way to get yield in that market is to go longer on the yield curve or take on credit risk, which is another alternative. But if you go longer on the yield curve, now you have price sensitivity. Rates go up, the value of your bond is going to go down. So in this strategy, we're going to increase current net interest income while protecting the price sensitivity of the bond. In this strategy, we're going to use a forward starting pay fixed interest rate swap. Now, what's the difference between the first example and the second? Well, in the first, the pay fixed interest rate swap, we call that a spot starting swap. What that means is that the cash flows between you and the swap dealer take place immediately on day one. Well, really in month one or quarter one, but immediately you're going to have cash flows between you and the dealer. In a forward starting swap, the cash flows don't start until after the forward start period ends. For example, if I said I was going to do a 2-year forward starting into a 5-year swap, for years 1 and 2, there's no cash flows between you and the dealer. Starting at the end of year 2, for the next 5 years, you're going to start making cash flows. So that's the difference between a spot starting in the first example and a forward starting in the second strategy. The hedged item on this one is going to be an individual available for sale security. That's the example I'm going to go through today. But you can also use a loan. And frankly, you can use a pool of loans or a pool of securities. All of those are good hedgeable items. But today we're going to focus on just the available for sale security. And the last goal could be just the opposite of the first. You think rates are going to persistently stay low for a long stretch of time. You're looking for ways to pick up income. So what we'll suggest in that situation is a receive fixed interest rate swap. So again, opposite of the first strategy, but again, it could meet your needs based upon your rate view and your interest rate position, interest rate risk position. The hedged item in this situation is floating rate, pools of floating rate loans. That's the most likely way you're going to attack this strategy. Now, it may surprise you that I have 3 different strategies that are exactly opposite of each other. I can tell you from our experience that on our balance sheet risk management desk that all of these strategies are being put into place as we sit here today. They're all very popular. And again, it's dictated by the rate view of the banks that we're working with in their risk position. So some banks think they want to put on long-term funding, lock it in, and others are looking for current income. So they're really using the receive fixed swaps. Again, this is going to be the 3 trades that we're going to talk about today. All right. As Tom had mentioned at the outset, please put any questions you have in the chat box. I'm going to try to answer them as we go. So feel free to fire them off and we'll attack them then. If we don't get to them then, we'll definitely hit them at the end of the discussion. All right, I'm on page 9 for those of you who have the slide deck outside of the presentation here. The page 9 is what we call our one-pager here at Chatham. It's really your cheat sheet or your reference point for the strategy. And the way it's laid out is on the left-hand side is what's going on in the balance sheet. The right-hand side at the top is describing the strategy and the accounting. So what takes place in the hedge relationship and what you're doing. And at the bottom, it's describing what is the actual hedge accounting. In this case, the hedge type for this trade is a cash flow hedge. That's GAAP ASC 815 accounting guidance. And so you have everything you need here on this one sheet. It's good for using internally for describing it to other management team members or the board, or it's also useful in talking to your auditors or your examiners, just to show them what the strategy that you're applying. So again, quick, easy cheat sheets that you have for, or one page that you have for this strategy. Well, let's talk through how this works. In the example I'm going to go, the bank, the financial institution is saying, look, I want to lock in long-term fixed rate funding on XX million dollars for the next Y years. So fill in the XX and the Y. So that's the start of the discussion. Looking to lock in long-term funding as efficiently as you can. So item 3, the first thing you're going to do is borrow from the Federal Home Loan Bank for 3 months. Or you could issue 3 months brokered CDs if you chose to do that. So first thing, borrow 3 months from the Federal Home Loan Bank. Second thing, item 4, is we're going to enter into the interest rate swap with the dealer bank, in which you're going to pay a fixed rate in exchange for a floating rate for that Y number of years you decided, on the notional amount equal to the XX million of dollars that you decided. And then you're going to need to document this for GAAP accounting, for US GAAP accounting, in a hedge designation memo. Now, when you work with us at Chatham, we do all this for you. We're going to put the hedge designation memo together. We're going to do all the effectiveness testing. Everything you need, we'll take care of. But those three things, 3, 4, and 5, are going to be happening pretty much at the time you're doing the trade. After 3 months, the first advance matured. Well, you have now committed to rolling every 3 months those advances for the term of the swap. So let's say you put on a 5-year swap. You're going to be rolling FHLB advances every 3 months for the next 5 years. When you put all that together, you will have fixed rate exposure for the entire 5 years. But you do have to do this step 6 every 3 months. Item 7 is really just straightforward. We put on the interest rate swap. You're going to have quarterly payments between you and the dealer based upon the fixed rate and the floating rate. And that net payment is recorded in interest expense. So that goes on the same line item as the interest expense for your Federal Home Loan Bank advance. So it's all nicely put there. When you put in the rolling advance interest expense plus the swap interest expense, or net payment, I should say, you put those together, that's going to be equal to the fixed rate that you agree to. Now, I'm not going to go through all those ins and outs today. If you have interest in talking more about it, happily get on a phone call with you later after the webinar. But the net payments go into interest expense. The last piece of the puzzle is US GAAP requires all derivatives to be recorded on the balance sheet at fair value at every accounting period. So if the derivative is an asset, you book it as an asset. If it's a liability, you book it as a liability. The other side of the entry for all those accountants out there, if we can nerd out for a second, the other side of the entry goes into accumulated other comprehensive income, AOCI. Now that's the same section of the equity section of the balance sheet that you put the available for sale security, unrealized gains and losses. That's where it goes down there. So those are the steps in the process. You go and you borrow from the FHLB, roll it every 3 months for the next Y number of years. Put on your swap, get the hedge designation memo, the payments go to interest expense, and in every quarter, you're going to book the value of your swap on your balance sheet.
David, in your example there, you've got a lot of X's and Y's, but what are the minimum and maximum maturities and dollar amounts that make all of these hedges cost effective?
Yeah, that's a great question, Tom. You know, the reality is if you're just doing a couple $2 million, $2 million, $3 million for 5 years, that's a good solid hedge that gets executed all the time. I'll tell you, it's going to be dictated by your balance sheet and your FHLB usage. It's going to be dictated by your interest rate risk position and what you're trying to do. But usually we're seeing a couple $1 million, it could be in $5 million chunks, and it goes up 25, 50, 100 million, depending on the size of the institution. The term, again, is going to be dictated by your risk position. So if you have interest rate risk sensitivities are just in line with you need more or less, we'll set that up to make sure it fits you. I'll tell you, most are going to be 3-4 years at the short end, all the way up to 10 years is typically. So you're like 3 to 10 years, and most trades are probably in the 3 to 5 year range on this pay fixed strategy. But that's a great question, Tom, on this one. Now, as I mentioned at the outset, excuse me, there is a way for banks who may use the Federal Home Loan Bank term advance as their match funding source. So what I have here is an example. I did this on April 2nd. The source of the information is from FHLB Chicago for the rates from the FHLB, and then the swap rates are from Chatham. So let's take a look let's put some numbers to this. On the date I did it April 2nd, you would borrow from the Federal Home Loan Bank at 22 basis points. That was the 3-month advance rate. On that same day, I did this for a 7-year, just for example. The pay fixed rate on that date was 1.37% in exchange for 3-month LIBOR, which was 20 basis points. When we put all that together, we sum 22 plus 137 minus 20. Your net borrowing rate is now locked in at 1.39%. So you've got fixed rate for the next 7 years at 1.39%. On that date, the Federal Home Loan Bank of Chicago said the FHLB term advance rate was 1.6%. Accordingly, you would have 21 basis points of savings by rolling the advance every 3 months and put the swap on versus just going out and doing a term borrowing from the Federal Home Loan Bank.
David, is that always a 2 basis points difference between the fixed rate and the net borrowing rate?
Yeah, that's a critical piece, Tom. You do have to remember the Federal Home Loan Bank 3-month advance rate is set every day by the FHLB. So that does change. And 3-month LIBOR is dictated by the LIBOR market as we know it today. So the difference that I did it on this day, the basis is what we call it, was plus 2 basis points. Now, on average, over a long data series, it's about 2 or 3 basis points is where that usually prices. But there are times in which it's lower than 2 or 3 basis points, or it's higher than 2 or 3 basis points. I think, and I don't have the statistics in front of me, but I think it's between 0 and 7 basis points is about 95% of the observations when you do a statistical calculation, or the distribution, I should say. There are periods of time that the basis could get higher. So the higher the basis between LIBOR and the FHLB advance will eat into this 21 basis points I'm showing you there. But I can show you the history that it doesn't persistently stay at that level. And frankly, it goes below the 2 basis points just as much as it goes above the 2 basis points over time. Suffice it to say, unless the basis was 23 basis points persistently over 7 years, or I should say 22 basis points, you would still be better off doing the rolling advance trade. You would save a bit by doing it that way. But it is a critical thing when you're doing this. The 2 things, you're going to have to roll the advances every quarter. You have to remember that. And the basis difference can impact you, but I'll tell you from history, it's usually not a big deal. All right, so that was the first strategy. Got through that one. Hopefully no one got hurt listening to that. The second strategy is hedging the available for sale securities with the forward starting swap. Now, page 13 again is the cheat sheet. It shows you the structure, it gives you the strategy and the accounting, and at the bottom it lays out the gap accounting. Now note in the hedge type, this is going to be a fair value hedge. We don't have time today to talk about cash flow hedges and fair value hedges and the differences, but just note that this cheat sheet gives you what is the hedge strategy and how it works. Let's piece it together though. In what we call the hedge of own the front end, hedge the back end. Let's look at the steps of what you're going to do. When I pulled this together, now I did it on March 12th, but I could update this any day. I said, okay, I'm going to go buy a 10-year, I think this was a single A rated corporate bond for the example I did. So I'll buy this corporate bond at 2.59%. Now, you can use anything. You can use agency, you can use treasuries, you can use whatever you want. I just happened to pick a single A corporate at the time. So first thing, buy a 10-year fixed rate bond. The second thing is we're going to enter into this forward starting pay fixed swap. When I did this example, it was 3 years forward starting into a 7-year swap. And the index we're using is Fed funds effective. Now recall the FHLB advance, I was using 3-month LIBOR as the floating index. In this hedge strategy, I'm using Fed funds effective. At that date when I priced it, that 3-year forward into a 7-year equals 1.95%. So that was the trades that you do. Buy the bond, enter into the swap. So when we put it all together, we have now synthetically made a 3-year fixed rate instrument with a 7-year floating rate instrument at the end. And the graphic at the bottom is showing what that looks like for your income statement. The red line is saying for the first 3 years, you're going to record interest income at 2.59%. So that's good. You're increasing current net interest income. But after year 3, the combination of that forward starting swap and the bond is now going to produce a floating rate, synthetically built, floating rate instrument at Fed funds effective plus 64 basis points. Accordingly, after year end of 3, you're going to now reset every month at Fed funds effective, whatever that is, plus 64 basis points. And that's the blue line. This is where you put together your interest rate view and your current needs on your interest income or your margin, in that you need to say, look, if I think 2-3 years from now the Fed's going to be up 200 basis points, well, I'm going to have now a bond at 200 basis points for Fed funds effective plus 64. I'll be yielding 264 in at the beginning of year 3. Now, if it doesn't meet that, so let's just say it stays at 25 or wherever Fed funds effective is, less than 5 basis points today, I believe, or maybe 7 or 8 basis points. If it stays at that level, you're now going to have a lower floating bond. But again, that was a trade-off. That was the risk that you were trying to mitigate by putting on the forward starting swap. And that's just what's going to happen in the market, or that's going to happen for your balance sheet. But again, I think this one makes a lot of sense for banks who are sitting on a lot of cash, because they get to pick up net interest income that's so important today, improving their margin, and then allowing for the Fed to move in the next few years up into, maybe 1.25, 1.5, 2 again, whenever we look at it.
Okay. David, your example, you use a 3-year forward start period. In the example, can it be a 5 and 5? And what?
Yeah, I mean, that's a good question, Tom. I mean, the reality is it's going to be dictated by the bank on what their comfort level is. We can do any term. We can do a 1-year forward into a 3-year, a 2-year into an 8-year. We can do a 3-year into a 2-year. Whatever is needed or fits the rate view and the risk position of the bank. I can tell you that the trades that we're seeing now for this one, when I did this in March, the 3-year forward starting was a very popular one. It's now starting to move down into a 1.5 to 2-year range. There's nothing more exciting about it than the fact that the yield curve is steepened. That's kind of dictating the preferences by the banks that are putting this trade on. So yes, you can put on whatever term you want. Forward start as far forward as you want, and put the tail end swap on as long as you want. Now, as I mentioned at the outset when I was going through the different choices, you can do this with available for sale security. We can do it with a floating rate, fixed rate loan, but we can also do this with a pool of fixed rate loans or a pool of fixed rate available for sale security. So we have a lot of things on our balance sheet we can do and use to make this work. But again, this strategy here has been used by banks who are sitting on a lot of cash, want to pick up current income because the cash is just dragging them down, and then protect the price value sensitivity of the bond that they put on. All right, so we're moving right along. The last strategy I have is using receive fixed swaps. So just like I talked about in the other ones, I have the cheat sheet, the 1-pager for you. It lays out the floating rate pool we're going to put on the receive fixed swap. The strategy and the accounting is on the right-hand side. And note at the bottom, the hedge type is a cash flow hedge. So if you're keeping score, the FHLB advanced rolling hedge was a cash flow hedge. The last example I gave was a fair value hedge. And now we're hedging floating rate loans or a cash flow hedge again. This page 16, again, it's a cheat sheet, your reference point that you can use at any time. But let's take a look at how this one works. So again, we're going to start with a pool of LIBOR-based loans. So you have floating rate loans, LIBOR-based index loans on your books. And we're going to synthetically change them to fixed rate by putting on this interest rate swap. So the receive fixed on the interest rate swap with the floating rate loans, put those guys together, we've now made fixed rate exposure for the balance sheet. Now, the critical thing for this hedge is that the hedged item, which is the pool of these LIBOR-based loans, needs to be probable to be outstanding through the entire hedge term. So if you said you're putting on a 5-year swap, receive fixed swap, you're going to need to make sure that you have enough principal in LIBOR-based loans that's greater than the notional of the swap. So let's say your swap is $10 million. You need to make sure that you have LIBOR-based loans that are greater than $10 million for the entire term of the trade. Now, the key thing though is, and this is the nice part of it, you can keep adding and subtracting to that pool through the entire term of the deal. For example, if a LIBOR-based loan matures in a month from now, and you re-up it with that customer and they go back in the LIBOR, that's cool. That loan stays in the pool. Let's say you had another one where a customer paid off at 6 months, but you had just made another loan to another customer at LIBOR base. That can go into the pool to take the place of the one that went off. So there's a lot of flexibility. The critical thing for management is to know that we just need to make sure we have enough LIBOR-based loans through the entire term of the hedge relationship. The other critical thing is if there are any caps or floors in the loans, you're going to need to make sure that those are covered off with the derivative. The way that we do it is we're going to get your loan portfolio and we're going to break it down based upon ones with floors and caps and ones with not, and set each one of them up at different pools. And based upon that, we'll decide on which one we're going to point to for the derivative that we're going to use. Now, what I have here on the left-hand side is the amount of what we call positive carry that's currently available to you if you're doing this trade. What is positive carry? It's just the difference between the received fixed and the current setting of, in this example, Fed funds effective or 1 month LIBOR in these two columns here. So what you're seeing is if the maturity is 3 years, 5 years, 7 years, 10 years, what's the difference currently between the received fixed rate and the floating rate? Looking at the 7-year point, the difference between the fixed rate and the Fed funds effective is 108 basis points. And if we were using 1 month LIBOR, it's 111 basis points. What does that do for you? It takes all those loans that are currently getting Fed funds effective, well, if you're using that, or LIBOR, and moving them up 111 basis points or 108 basis points in yield. So that's good. That's a way to pick up some income.
David, why wouldn't I use my balance sheet for fixed rate hedging as or fixed rate lending as opposed to using the swaps and hedging?
Tom, you can do that. The reality is that's available to you if you have the situation where you're on excess cash or you want to get exposure out. You can definitely do it by buying fixed rate securities. You can do it by doing fixed rate loans. Now, with loans, the challenge is if you said, boy, I really like to put on 7-year fixed rate loans right now. The question for management team is how long is it going to take me to fill up that bucket? How long is it going to take me to find enough of my 7-year fixed rate loans to my customer base? Now, if you're in the security land, you can obviously buy security very quickly. But if you think about it, if you're adding it on, it could take some time to put them on and meet your needs. With the swap, you pick exactly the time and the duration or the term that you want. You put it on very quickly, but just as importantly, you take it off quickly. Let's put it in a situation, this is common when you're using hedge strategies. You put it on today, 2 years go down the line, you say, boy, this isn't really doing what I wanted to do. I thought rates were going to do different things or my balance sheets changed. We can terminate the swap at that point and get you back into your original position. So the swaps give you the flexibility to put on the term that you want, but also take off the exposure whenever you want to. Now, the question is, there's another question I should say. What if you don't have LIBOR-based loans in your books? A lot of banks who don't have LIBOR-based loans would find that they have prime-based loans on their balance sheet. So what we've been using is the Fed funds effective swap. That's the floating index as Fed funds effective to hedge prime-based loan pools. Now the same rules apply. You have to break them down into the pools based upon caps and floors in it, or you got to make sure that you have prime-based loans outstanding through the entire term. So all that stuff applies. But when we're using Fed funds effective, we need to make sure that the relationship between prime and Fed funds effective is pretty tight, that if one moves, the other one moves back and forth. So we run these regression equations. Now what you see here, and you can't possibly read what those equations say, but one is a 5-year regression, so going back 5 years. The other one is we went back to the financial crisis when things were all volatile and messed up. And we ran the regression equation. The key thing from the accounting side is that the R squared was greater than 99%. Now, I'm sure all of you out there are remembering from your statistics class from your college what R squared means, but I'll refresh your memory. That is the coefficient of determination. And really what it means is the line that I calculated, the line I drew through those those data points, how well does that equation describe the relationship? So accordingly, the higher it is, the better. The best you can get is 100%. So in this particular case, in those two strategies or those two periods of time for the regression, these guys were highly related to each other. So it's a Fed funds effective proves to be a really good way to hedge those prime-based loans. All right, so I've gone through all the strategies. Let's go back and summarize them. We start with what's your rate view, what's your risk position. Your goal was to protect against rising rates. We're going to suggest pay fixed interest rate swaps. The hedged item most likely going to point to rolling FHLB advances or brokered CDs, rolling brokered CDs. That's going to be the answer to that question. If you're looking to increase current net interest income while hedging the tail end, we're going to suggest the forward starting fixed rate, pay fixed interest rate swap. Now, that hedges the available for sale security in the example we have, which is again is the most common one we're seeing today, but it could be an individual loan or pools of loans and securities. A lot of flexibility on that particular hedge relationship. The last one is increasing current net interest income because you think rates are going to stay low and persistently low for a long stretch of time. Pick up current net interest income and put some more duration on your books. That's the receive fixed swap. And we do hedge floating rate pools. Again, as I mentioned just a second ago, it could be LIBOR pools or it could be prime-based pools. So those are the strategies that we have for today. I would encourage you, if you have any questions, fire them off in the chat box, and Tom and I will attempt to answer them as I get closing into the end of the discussion. What I have here on page 21 is our Chatham weekly rate sheet. Now, we put this out on Mondays based upon Friday close, and what it gives you is a bunch of different structures that you can see the pricing on. Maybe interesting and useful to you. And on the second page, on the right-hand side, we have floor and cap pricing. And on the left-hand side, we have some other swaption type pricing that could be used in different ways. If any of you have any interest in getting this, please send me a note and I will get you on the distribution so you can have access to these rate sheets. And again, it's a good information source, even if you're not using derivatives, that you'll know where rates are in the derivatives market and can give you an idea of maybe helping you price loans or even when you're looking at security portfolio. The last section I'm going to mention is if you would go to chathamfig.com, you can have access to all of Chatham's market insights. So this is going to be all the information we have about derivatives and the derivatives market, have some primers and education videos on there that help you understand how things work. And it's just good up-to-date information about what's going on in the derivatives market and it could potentially impact you. With that too, we have, I think, a really useful resource, which is the LIBOR, we call it the LIBOR market update, and it was dated March 17th of 2021. My colleagues put this together, and this is a reference tool for LIBOR going away. So LIBOR is going away here at the end of this year, and SOFR, S-O-F-R, is going to be taking its place. So this is a nice little reference tool. You can go to chathamfig.com, navigate to the insights at the toolbar, and filter on the financial institutions. And you go down a few slides or a few clicks, and you're going to see this reference tool. Use that for reference. It's good for your loan if you have LIBOR-based loans, LIBOR-based securities, what's going on. A good reference tool there. Lastly, here's a picture of me. I always like to tell if I was live, I would sign these for you if you had any interest. But my contact information's here. Please feel free to contact me with email or phone call if you want follow-up information about what I described today, or if you'd like to get on that distribution for the weekly interest rate sheet. So with that, Tom, I'd like to go to some questions if we have any.
We do have some questions. And the first one is, you've discussed the swaps. What about use of caps and floors in hedging instruments?
Yeah, that's a good question too. Again, I focused on swaps. It's usually the easiest one to first introduce to people to understand what's going on. But caps and floors are definitely available to use in some of these strategies. My colleague Todd Kupia, who runs our balance sheet, who's our balance sheet strategist and runs a balance sheet risk management desk, he has he likes costless collar strategies right now. He thinks make a lot of sense too. So yes, caps and floors, and again, when you look at that pricing sheet I just showed you, those prices are there. But we definitely work with clients on using caps and floors. I will tell you though, the lion's share of the trades that we'll do are still swaps.
Okay. Second question. You talked a lot about the strategies and using hedging and swaps. What happens when the hedging instruments have to be terminated early?
Yeah, that's a great one, and that does happen. I mean, it's in balance sheet hedging. It's common for folks who are looking at it and actively looking at their risk position in a rate view. So to answer your question directly, what happens in a cash flow hedge is if you terminate the interest rate swap, the hedge relationship ends, and any unrealized gain or loss in AOCI is just amortized or accreted to income over the remaining term of the original swap. So let's say you put on a 5-year swap, you're 2 years in, you terminate it, so it's got 3 years left. Whatever the unrealized gain or losses will be amortized or accreted over the next 3 years. Now, for fair value hedges, that was the middle trade strategy that we talked about today. In those situations, the unrealized gain or loss, it just becomes part of the basis of the security or the loan that you are hedging. And that basis, it really just looks like a premium or a discount when you buy a bond. And it's just amortized or accreted over the remaining term of the bond or the loan. So it's not the term of the swap that you use, but it's the remaining term of the bond or the loan. Again, it's a basis adjustment that you'll use to make that work. So yeah, it's common to happen where the derivative goes away because of the management's decision, and then we just take care of it through the natural progression of cash flow hedging or fair value hedging.
Okay. Another question. We've all heard as bankers that the LIBOR is going away in the near future and SOFR or some other index is to be used. How does all that impact hedging instruments?
Yeah, that is a great one. And the reference tool I mentioned just a couple slides ago is a great place to go. The reality is that there's a few moving parts there. If we look at the derivatives market, if you have LIBOR-based derivatives, for anyone listening on the call, that stuff has already been taken care of. There was a protocol, an agreement that you would do that changed your ISDA agreement that changed LIBOR, and when LIBOR is no longer quoted, it's going to be called fallback SOFR, and that's a rate that's already locked in. So the derivatives market has dealt with it. The challenge has been with individual loans, so bank loans that are LIBOR-based. Each of the loans you have that are LIBOR-based, you're going to need to go into the section that talks about LIBOR and amend that section if it doesn't have good language in it. And again, if it's a 3, 4, 5-year-old loan, it may not have very good language in there for transition. Stuff that was done in the last year or so, a lot of banks have already taken care of that. But suffice it to say, you need to make sure your loan docs allows for LIBOR going away and you make that fix. Just as importantly, and this is one that some folks miss, is the securities portfolio. You could have LIBOR exposures there. You could have had subordinated debt issuances that you bought from other banks. You could have TRUPs still outstanding from years and years ago. You could just be buying CMOs that are LIBOR based. Each one of them are being dealt with differently because they can't just be taken care of from the ISDA, because ISDA doesn't control the cash market. But what was nice that just happened in the state of New York, the legislature in the state of New York has modified en masse any and all contracts that were referencing LIBOR that were based on New York law. So that could be the sub-debt deals or trust deals or some other package deals that you have. The agencies, Fannie, Freddie, all those folks have taken care of it as well. So things are starting to work their way through. The reality for the timeline is the end of 12/31 this year, LIBOR can no longer be used. And that's from in the banking sector in the United States. LIBOR for 1 month and 3 months is still going to be reported through June of 2023 as we stand today. So any of those legacy contracts you have, those can still be quoting LIBOR until it stops in June of 2023. So we got a little bit of time. What we encourage folks to do is do an inventory of all their loans and securities to make sure they're taking care of all the LIBOR-based stuff and making sure they know when things are going to go away.
Okay, thank you. David, when you're discussing swaps and hedging with community banks, who are you typically speaking with within the bank?
Yeah, so it depends. For loan level hedging, which we didn't talk about today, that's usually the lending team. That's the senior lender, CEO, CFO, CLO are all going to be involved as well. That's for the loan level hedging. For the strategies we talked about today, that is going to be the finance group, the treasury group, whatever you use the term in your bank, and ALCO. So it's going to be, we're going to be talking to the key decision makers in those functions, and then presenting the strategies usually to an ALCO committee, which could be management ALCO or board ALCO, depending on the way that the structure of the institution. But yeah, again, the strategies today we're usually in the finance/treasury function of the bank when we're doing these strategies.
Okay. I don't have any other questions at this point.
Okay.
So David, I want to thank you for a very informative presentation at a time when our banks are asking a lot of questions. Interest rates seem to have no forward certainty these days, but the community bank customers do seem to want the lowest rate, and they overwhelmingly seem to want them fixed these days at the rates they are. So this has been very helpful. I'd like to thank all of the attendees again, and don't hesitate to call David or your banker's bank contact if you have any questions. A lot of material presented today, and I'm sure David would love to have future correspondence and communication with you. Also, please fill out the questionnaire so we at Bankers Bank can better serve you going forward. Thank you again.